Are my retirement accounts in good order? So people are really wondering if they should do long-term care planning now, but my opinion is that they really can't afford not to do the planning right now. So we're going to learn why. So first of all, one of the things that we've had to deal with is interest rates. They've plummeted. And because of that, all linked benefit policies had to raise their rates on new policies. Now remember, when your client has a linked benefit policy, once that policy is issued, their premiums are guaranteed for life. So in-force policies, there's no effect, but future policies, they can, continue to change the rates. So recently, all carriers raised the rates because the interest rates went down so much. And there may be another rate increase coming first of the year due to a new regulation around reserves. So that's a wait and see. But again, that's another reason to get your client in now before there has to be another rate change. Now with standalone policies, they're going to be exposed, your clients will be exposed to rate increases, whether the policy is new or existing, because those premiums are not guaranteed. And so the companies can try to regroup by raising rates on current policy holders. Then you have long-term care riders on life insurance. The pricing on those riders are generally not impacted, or they're minimally impacted based on how aggressive the carrier's past pricing was on that rider. Remember, a long-term care rider on a life insurance policy is a small component. That charge is so tiny on that policy that most carriers probably will just hang in there with their pricing, though that's, not guaranteed. And then you've got your clients trying to self-fund. And, to self-fund safely, you want to put your money in conservative investments, or better yet, even investments with guarantees like CDs. Well, CDs aren't paying anything right now. So what's the solution? And that would be a linked benefit policy or some life insurance policies with an LTC rider, because they can guarantee the premiums and benefits from the day of purchase. Now, more importantly, they get that leverage on day one. So the minute they pay that first premium, even if it's just a monthly premium, that money has been pre-leveraged and it's ready to go at a moment's notice. So now they have a non-correlated investment in their portfolio that's been pre-leveraged and has a predictable rate of return based on when they would use that policy. As for market challenges, clients, fear with parting with their assets in a down market, and even financial professionals are concerned with single pay premiums. A lot of people still haven't gotten it out of their head that linked benefit policies are nothing but single pays. Today we have a lot of options, but they're concerned because you remove a large sum of money from an account that's already significantly down, and that money can't be grown back or grown forward. What makes a lot more sense is to solve that problem with a 10 pay or a pay to 65 premium schedule. Your smaller premium is still going to provide that full immediate leverage the minute you pay that first premium. And again, with linked benefit policies, they're guaranteed. But that's going to leave most of the money in the account to recover and grow back. Therefore, the little bit you get less in coverage by going with a 10 pay is going to be more than made up by the fact that that money is able to grow back and grow forward. And then you have a death benefit on those multi-pays. Remember, the death benefit is still significant when you have a multi-pay. So in those early years, you would have just paid a little bit of money. But if there, and we have people who will buy Care Matters, and then, it doesn't happen often, but you might have a death in the first year or two. And now the death benefit also helps restore the portfolio balance. So doing it, stretching out those payments is really what makes sense right now. Then we have the pandemic considerations. So applying for a policy safely. And what that means, especially to your clients who are getting a little older, people over 60 means, they're trying not to see as many people in person. Fortunately for linked benefit policies, you have simplified underwriting. So when you're presenting a linked benefit policy, your client literally can talk to you about long-term care planning over the phone. They can do the underwriting over the phone because it's just going to be a telephone interview, and they can sign the application on their smartphone or computer, which means they're not talking to a person. Remember, when you show a linked benefit policy to your client, there's going to be no paramed coming to their house. There's going to be no fluids, no blood draw. They literally can do this from the comfort of their own home in their easy chair, if that's where they want to be. Also, we have the concern of receiving care safely. I'm sure you all are quite aware of the concerns of people who have been in nursing homes, particularly, but even in assisted living facilities. And people are looking for alternatives of how to receive care in a safer manner. So that's where cash indemnity benefits. When you show a cash indemnity policy to your client, you're going to have the opportunity to use that money for alternatives to meet the care needs, that you can literally get care from your family members, whether it's temporary or permanently. The family member can be reimbursed for providing the care. So you can pivot your care needs on your own terms. No permission from the insurance company is needed. Now, as for income security, your client's going to have affordability fears right now, and that's going to come from basically two areas. If they're still working, they're worried about their job security. Am I going to have an income in the future to pay premiums? And if they're already retired or just about to, they're going to wonder if they can afford premiums, continued premiums, and still have enough income for the rest of their life. So with a linked benefit policy, you have escape clauses. Now, one I think everyone's aware of, but there's another one a lot of people are not aware of. So we're going to start with the one everyone's aware of, and that's your refund of premium option. These do vary by carrier. And basically, they provide an option where you can get all or most of your money back if you decide you don't want the policy anymore. But more importantly, there's a lot of people who wonder about, well, what if I want to keep the policy, I just can't afford to pay for it anymore? And that's the option that a lot of people don't know about, and it's called a reduced paid up option. Now, that availability does vary by carriers. Not all carriers offer that. Nationwide does. So what that means is, let's say you have a $600,000 pool of LTC benefits, and you're paying a 10-year premium. At the end of 5 years, something happens and you just aren't comfortable paying premiums any longer. All you have to do is call us up or go to your advisor. He'll call us up and we will give you some paperwork to make it a reduced paid up policy. And what we'll do is take the pro rata amount of premiums that you have paid and reduce your policy by what you haven't paid. So in the case of where you've paid half the premiums for a $600,000 policy, we'll reduce it to $300,000 and now call it a paid up guaranteed policy for $300,000, and you're done paying premium. So this is an escape clause that's very attractive to people because they can get into it while they can afford it. And if something changes, they can just, instead of turning it in and losing all coverage, they can keep the coverage that they've paid for. Now, another risk is the risk of waiting. So underwriting for long-term care has become more fine-tuned. And so waiting comes with the risk of a change in health. Now, what I'm going to show you on the screen here are actually statistics for traditional long-term care. So you can, because we have more information on that. But between 2012 and 2019, so we're talking a 7-year period of time. That's not a very long period of time. This is what's happened to decline rates. If you're below the age of in a 7-year period of time went up 228%. Now they're still relatively low, but they've gone up quite a bit. In other words, being young is no longer a guarantee you're going to get a policy. Between the ages of 50 and 59, the declines went up 50%. Now, if we get into the ages where people are often buying this, between the ages of 60 and 64 in 2019, almost 1 in 4 were declined. Between 65 and 69, almost 1 in 3 were declined. Now, ironically, the only category that has not changed is the age 70 and older. And in those categories, nearly 1 in 2 were declined. And it's been that way for a long period of time. But there is some good news. When you apply for a linked benefit policy, you actually have a better chance of getting an approval. The decline rates are 25 to 50% lower, depending on what age you are, than applications for a traditional long-term care policy. So going the linked benefit route makes sense as far as having a better chance of getting an approval. Now, there's also a financial cost of waiting. So the longer you wait, the more the policy could cost. And if you're interested in inflation, the less benefits you're going to get. So this chart illustrates what would happen by waiting. So if we're at 55 years old and we buy a $5,000 a month benefit with 3% compound inflation and arrange to pay for it over a 10-year period of time, at age 80, our benefit would be worth over $10,000, almost $10,500. Our annual premium would be $11,580. And our total premium of till you're 60. One could argue that depending on what else is going on with your investments, maybe it was okay to wait those 5 years. You are going to lose about $1,400 a month in LTC benefits, and it's going to cost you about $1,800 more a year, or $18,000 more total. But you still end up with, some decent money. But now get to age 65, and we have less time to compound. So now our monthly benefit is going to be down to $77.90, and our annual premium is over $16,500, or $165,000 total layout. And if you wait to 70, you've really missed the boat, because your policy no longer has much time to compound. So we're down to $6,500 a month in compounded benefits. Our premium is $25,000 a year. And this results in costing more than double of what it would have cost you at 55, and nearly double of what it would have costed you at age 60. So there is some true financial cost to waiting. There is no age that's too early to do this. Nationwide will sell these policies as young as age 30. So there, waiting does not make sense. Now, how do we plan for enough coverage? So, a lot of the clients, their concern is, well, what kind of a benefit period should I buy? I mean, I don't know how long a claim will last. And then how do I efficiently plan for the rising cost of care? So we're going to look at a couple of variables here to solve that. And the main thing is you want to look for value. So I'm going to give you a couple of components of value here. First of all, people will ask me, well, what's the average length of claim? I see out there on the internet, they talk about 2.2 years and so on and so forth. Well, those low figures are averaging every claim that ever existed, which means they're averaging in all of those first-year claims that end quickly, with those few claims that last more than 6 years. So you end up with this very low number. People don't insure for the short term. They insure for the long term. If you knew you were going to only have a long-term care experience of 3 or 6 months, I think 99.9% of people would never buy the insurance. So we really need to look at what happens if you make it a year. So take out all the claims that end in death or recovery in the first year, and just look at claims that last 1 year or longer. And then the average goes up to 3.9 years. And so use 4 years, you round it up to 4. That's sort of your starting point. If your client's on a budget, then do 3 years if that's what's more affordable. You know, anything is better than nothing. Any type of coverage will help stop the bleed of their assets. So whatever they can afford is fine. But start with 4 and work up from there if you can. So there's a reason the 6-year benefit period is most popular. One, it's very rare for a claim to exceed 6 years. And so, you know, basically only about 5% of claims will last longer than 6 years. So 6 years gives you a very solid amount of money to work with. Number 2, it's a great bargain, the value you're going to get. And here's why. If you were to use a single premium, just as an example, but if you were to take $100,000 and compare a 6-year benefit period with a 4-year benefit period, you would be shocked to find out the 6-year benefit period will actually provide more LTC benefits. It's going to pay a little less every month, but if, for example, if your 6-year benefit period would offer $132,000 more on the back end than a 4-year benefit period. And if you were only on claim for 2 years, because the 6-year benefit paid a little less per month, your downside loss would only be $13,000. But your upside gain, if you were to go the 6 years, would be $132,000. And to break even, you only need to be on claim less than 4.5 years. And with 4 years being the average, your chances of breaking even are pretty good. So a 6-year benefit period really does make a lot of sense. And that's why it's the #1 benefit period chosen. Now, as for inflation, that's going to help keep up with long-term care costs. At Nationwide, we have 4 options: a 3% simple, 3% compound, 5% compound, and U.S. medical care inflation, which tracks the medical component of the consumer price index. And so that, and then it's got a cap, and we're not going to go into that today. It's a very interesting concept that is attractive to certain people. The important thing to remember about inflation is be careful when you're looking at 5% compounded older clients. So 5% compound makes perfect sense for your client who's in their 40s, their 50s, even their early 60s. But once your client gets into the high 60s, then you've got to watch and look. You know, we have a report that'll show you this, but you want to look at how much benefits they'll have at age 80, because when you start with 5% compound, your bottom line for the same money is lower, and you have to catch up to the 3%. So you always want to look at that analytical page on the illustration. It's page 22. It's going to give you, it's the best page of the whole illustration. But it'll make sure that 5% made sense for those older ages. Generally, if if you have someone in their 40s or 50s, 5% inflation makes a lot of sense because you don't know how costs are going to go in the future. But if you have an older client, 3% compound is probably better because long-term care expenses have been at about 3% inflation. And being that they're older, it's probably going to make a little more sense. Now, what type of coverage options do you have? I'm not going to go into a lot of detail, just sort of some highlights here, but your traditional long-term care policy it's a one bucket approach, but the only thing it pays for is long-term care. So it is a use it or lose it product. The premiums are not guaranteed. You will have full underwriting with this product. So there's, and again, the decline rates I showed you, it has the most stringent underwriting of all the products. You do get to choose benefit and inflation periods. Probably the most flexible part of these policies, though, is the choice of elimination periods that you won't get with the other products. These are HSA eligible and tax deductible if you can meet the requirements for the tax deduction, but currently only reimbursement policies are available. Then you have long-term care riders on life insurance. These are for people who have a life insurance need, but also have care concerns. So they want a life insurance policy for now, but something that can transition into long-term care coverage later. These are good for people who are, 45, 50 years old, still have a mortgage, college bills for children to protect. So life insurance really makes sense for them, but they're also concerned about long-term care. Put that long-term care rider on the policy. And when their life insurance needs are no longer there, the policy has now become long-term care protection for them. Any unused death benefits are paid to the beneficiary, so there's no loss with these. Premiums can be guaranteed. There's guaranteed products and riders to guarantee products you can add. These are usually not HSA eligible or tax deductible, however, but you do get a variety of base policies to choose from so that you can meet your client's overall financial strategy. And they do have full underwriting for both the life and the long-term care component. There's very little customization. We do on our rider, we do have a choice of benefit percentage, but generally they don't have much customization. And depending on the carrier, they come in cash indemnity and reimbursement models. Linked benefit policies are for the person who's looking for long-term care coverage. The death benefit only there is only to protect the premium because it's guaranteed that at least the amount of money you paid will be, at least with Nationwide, their death benefit will never be less than the premiums you paid, and depending on the age you buy it, could be more. So there's no use it or lose it. You get that simplified underwriting with these. You get to choose your benefit period and your inflation, or if you don't want inflation, you can choose not to have that. Depending on the company, and not all of them do this, Nationwide does, the LTC premiums with Nationwide will be HSA eligible and tax deductible. They are not with some of the other companies, so you have to check. And then depending on the carrier, there's cash indemnity and reimbursement models. And finally, there's a long-term care annuity. There's no use it or lose it with that. It does require a single premium. That's the only way to pay for these. All of your other options, you can do multi-pays. In fact, with the traditional long-term care policy, the life pay is the only option. With the long-term care annuity, the single pay is the only option. The premiums are guaranteed and you do get the simplified underwriting, but they are not tax deductible ever or HSA eligible ever. They are not. And they are all reimbursement plans at this time. So it gives you an idea of what you have to work with. Now, how can Nationwide help? Well, people need resources, and we have a full suite of long-term care solutions that can be customized to fit your client's needs. So if they're looking truly at long-term care coverage, we have our Care Matters products. If they're looking at life insurance, they can do variable with a guarantee. They can do indexed universal life with a guarantee. And they can do guaranteed universal life, of course. So every option we have has an option to put a guarantee on it. Flexible long-term care solutions are a must for many people, especially right now in this pandemic environment. So Nationwide is a cash indemnity product that's going to provide choice, control, and flexibility to your clients. And people want guarantees. So all of our Care Matters policies, and as well as some of the Nationwide, if you put the guarantee rider on it, will be guaranteed. Both the premiums and the LTC benefits will be guaranteed. People want tax breaks. Now, Care Matters 2, and this is the only one that has this, but with our Care Matters 2 policy, long-term care premiums are HSA eligible and can be tax deductible to the individual if they can meet the requirements. I always tell people, go for the tax deduction first. If you don't meet the requirements, then pay for it with your HSA dollars. But you want to always save those HSA dollars if you have a tax deduction available. Now, businesses really want tax deductions. And again, Care Matters 2 only, has LTC premiums that are eligible for the business to deduct the taxes. If you have businesses, clients that own businesses, buying the policy through the business is the cost-effective way to do it, because the deduction is guaranteed to happen. There's no requirements. You get the deduction. It's just a matter of how much you're going to get based on the type of business entity that you are. And then your high net worth clients have estate planning options. A lot of your high net worth clients think that they can just self-fund, and they can. I mean, they're extremely wealthy. If they have estate tax liabilities in today's world, they're very wealthy. And yes, they can afford to self-fund. The problem is when they self-fund, which they will do inside the estate, they've set themselves up to pay unnecessary estate taxes if that money is never used for long-term care. So with our cash indemnity solution, we have a way to put long-term care coverage in an islet to help prevent that unnecessary state taxation. That's a discussion for another day, but you can talk with Derek and Peter about those cases, and they can get you in touch with us. And again, our entire suite is cash indemnity solutions. So regardless of what the estate planning needs are, we have something that will work in that arena. Now, as for the products we actually offer, on life insurance, we have a long-term care rider, a New York version. Of course, it's New York specific. We also have our LTC rider too, which is available in all the other states except Montana. We have LTC rider on survivorship IUL. So this can be a really good opportunity for people who both want to buy, they don't have a life insurance need on the first death, but they're doing some legacy planning. They can save money by putting the rider on a survivorship policy versus doing 2 individual policies. Then for linked benefit policies, we have Care Matters too, which is available in all states except for California and New York. And then in California, we have the California version of Your Life Care Matters. And in New York, there's a New York version of Your Life Care Matters. All, of course, paying cash indemnity benefits. So, I keep talking about cash indemnity, and I'm very passionate about this. We were the first company to offer a linked benefit policy that paid cash indemnity benefits. In the past, they had all been reimbursement, but we're so passionate about cash indemnity at Nationwide because, again, the money can be used with no restrictions. We place absolutely no restrictions on how you use your money. And when you think about the pandemic right now, here's an example. Let's say you have a mom who's staying in assisted living, and the daughter's concerned about the revolving door of caregivers, and she calls her boss and says, I need to bring my mother home and take care of her. I need to cut my work hours by 30% because I'm going to have to spend part of my day taking care of my mother, at least until it's safe to take her back to her facility. Now, mom has a cash indemnity policy. And so now she can pay her instead of paying the facility. And even more importantly, the fact that that money is coming from a policy, not mom's checkbook, makes the daughter feel less guilty about accepting the money. So this is just a positive from all around. You can pivot your care at a moment's notice. Excuse me. Because the benefits are paid directly to the policy owner. There's no bills, no receipts, no permission needed. And this can be very valuable if you have to change your plans very quickly. This is priceless because you just do what you need to do because you're working with cash. And you get to collect the full available monthly benefit. When you have a reimbursement plan, you may have out-of-pocket expenses, even though you have a policy, because some of those expenses aren't covered by the policy. When you have a cash plan, that cash can be used for ancillary expenses that a reimbursement plan wouldn't cover. But with a cash indemnity plan, everything is covered because you have cash. And any money you don't need, you can save in your bank account to pay for the future cost of care And, keep in mind with the linked benefit policy, you don't want to take less because of the way they're structured. You want to take it all and put it in the bank, so you have it all for later. So to summarize, waiting can be a risk. There's a higher cost and less LTC benefits if you're doing inflation, and there's more chance of a decline. Market fears can be smoothed over with those multi-pay premiums. Remember, 10 pays and pay to 65s are very cost effective, and they can really help with the portfolio management. And then your cash indemnity is going to give you your most flexibility with your care choices. And Nationwide has an entire suite of long-term care solutions on which you can get there's anything you want, we can find a way to put a guarantee on it so that your client will have the knowledge that their premiums can never go up. So do we have time for a Q&A, or are we just moving on?
I think what we can do, I know you've got a hard stop, so I think if we can give Josh a little bit of time, and then if you're still around, unless there's some quick questions, we can open the floor. Does anyone have any questions? You can unmute yourselves. Otherwise, I think, Derek, let's hand over to Josh. And Sean, thank you. As always, a brilliant presentation.
Thank you.
Yeah, thank you, Sean. Some great insight there. One thing I'll just add, early on in the presentation, you mentioned there's sort of this common misconception around the linked benefit products that they're single pay premiums only, and therefore, only older high net worth clients can afford to purchase them with large, $100,000, $250,000 lump sum payments. It's really not the case anymore. We have flexible premium options, and we're seeing more and more clients, 35, 45 years old, maybe they've seen their parent go through a long-term care type situation, and they're purchasing policies earlier because it makes no sense to wait, and they're doing flexible, 10 pay, 20 pay, paid a lifetime. So we're seeing more and more of that. So I think the landscape of linked benefits in general is changing. But again, thanks a lot, Sean. Appreciate the insight. That's great stuff.
I do have one thing. I do have one thing to add. If you have a client, one of the other things that interest rates did, all of the companies lowered their maximum age to 70. You used to be able to buy these to 75. They reduced it to 70. That's another, if you have clients who are approaching the age of 70, you're right at the end of when you can get these. So get the age 75 out of your head. That doesn't exist anymore.
Absolutely. Yeah. Some hard restrictions there.
Okay.
So thank you, Sean.
Thank you for having us.
Absolutely. So we're going to switch gears here over to Josh Potvin, who is our disability wholesaler at Principal. He's going to talk about developing an executive benefit strategy using DI. So, most people are really underinsured when it comes to protecting their income. I think that's even more true when you're talking about these high earning executives and, people that are running businesses. Not only is there sort of a large income protection gap there, but these sort of executives, they're looking to, retain and reward key employees with a benefit plan that will actually provide value, to their employees. So without stealing too much of your thunder, Josh, I'll hand it over to you. And thanks again for joining.
Thanks, Derek. I'm hoping you see my presentation on the screen and can hear me loud and clear. Can you just confirm that's the case?
Yep, I got you crystal clear, and I can see the presentation, Josh.
All right, thank you, and good morning, everyone. I'm going to be very efficient this morning, knowing that everyone has other things to do after this presentation. I'm going to give you a very quick disability update. So if there's one thing to take away from today's presentation, the disability insurance market is going gangbusters, and it's probably not surprising to anyone. So a bull market is opportunity for you to help clients reach new clients, grow your practice. What we've seen over the last 6 months, sort of almost every couple of months, at first we saw a lot of doctors who wanted disability coverage, medical residents and attending physicians. Then the dental market opened back up once practices opened, and we saw an influx of dentists securing income protection. Then we saw a volume of professionals who were quoted prior to COVID hitting, but kicked the can down the road, and then they realized it was time to act. Now we're seeing a high volume of small business owners and businesses in general, because they've taken inventory of their situation. Their business is sustaining, it's growing, and they want to make sure they have a plan in place. So the timeliness of this presentation is very appropriate. So thanks for giving me the floor today. As far as electronic capabilities are concerned, I'm going to say Principal has everything. So the way we've done business has changed in recent time. So the high volume of business, the way that we can support that and get the business through underwriting is through e-app, e-delivery, e-signature, human API, e-everything. Okay, on to the presentation, on to the conversation. The risk of disability is real. I've given these presentations every year, and we were at Foxborough, we were at TPC, we were at Babson. Statistics. No one thinks they will become disabled, but statistically speaking, it will happen. It's the #1 cause for early retirement. It's the #1 cause for bankruptcy. It's the #1 cause for foreclosure. So it's critically important to have a plan. Disabilities come in all shapes and sizes. Every time I share this graphic, I focus on one in particular. It's injuries. Injuries and accidents make up less than 10% of all long-term disability claims. So, people get sick. Bad things happen to good people. Having a plan is just so critically important. This morning's conversation was really centered around an executive disability plan. Now, executive is in quotes for a reason, because there are many small companies that we implement these plans for, and they say, we don't have any executives. You don't need to wear a white starched shirt and a tie, if anyone even wears those anymore, to qualify for an executive disability plan. It's really focusing on the top talent, the highly compensated at a company. So just keep that in mind as we discuss implementing an executive disability plan. And again, no surprise, we're doing this for the company to protect the employees, as a tool to recruit, reward, and retain, and to make sure the top talent has proper income protection in place. It's not rocket science, it's critically important. Again, the term executive disability plan, fancy. It's very simple. It's essentially creating an income protection plan using an individual disability policy and really targeting the top talent at a company. Most commonly, and you'll see in the last bullet, it's on top of an employer's group long-term disability plan. So for the folks joining us today, maybe you do group benefits, maybe you don't, but your comfort level in knowing how the two policies and the two plans work together is critically important. I'll share with you the graphic here, and this is an example of how the two programs work together. So we have a highly compensated individual making $350,000. That individual, while healthy and working, on the first column, their monthly gross income is $29,000. After taxes, assuming a 35% tax bracket, their take-home pay, the second column, is approximately $19,000. So healthy, highly compensated individual with take-home pay and a great lifestyle, $19,000. If that individual were to become disabled, and in this example, they have group long-term disability coverage through their employer, that employer plan, the middle column, is 60% to $10,000 a month. That's the most common group long-term disability in the market. They're disabled, but wait, the company pays the premium, so the disability benefit is taxable. So the fourth column is saying highly compensated individual, disability benefit after taxes is $6,400. That's a great foundation. They are significantly underinsured. Significantly underinsured. So the last column on the right is simply showing how we can use individual disability coverage to provide supplemental benefits to the group plan to make sure this individual is properly insured. And you'll see here, it's right at their take-home pay, $19,000 a month. Simple visual. This is the business that I do all day, every day. Professionals with group long-term disability who need more coverage. You may have heard of the term executive bonus. Fancy terminology, very simple concept. It's when the employer pays for the cost of the individual disability policy, but what they do is they put the cost of coverage in the employee's paycheck, so they give them a bonus for the premium, so then the employee pays for it through payroll deduction, ultimately being a tax-free benefit. They're taxed on the payroll and the premium, so the benefit is delivered tax-free. Fancy terminology, not complicated at all, just a way to design a plan for the top employee, the key employee, to get a tax-free individual benefit. I'm jumping ahead because here's where the rubber meets the road. It's simply you are working with a company, a business owner, maybe a number of employees at a business. How do we address the problem? How do we build the plan? Well, there are essentially three scenarios to consider. The first, let's call traditional. That is we've ran a quote, they've decided on a plan design, and they're going to go through underwriting to apply for coverage. It's standard rates, and it's traditional underwriting, either simplified or full, depending on age and benefit amount. The next scenario is still an underwritten program, but you have 3 or more employees. That's called a multi-life program. And the advantage of that is discounted rates. We can offer a 20% discount when 3 or more employees at a company apply for benefits. Again, subject to underwriting. The last program, guaranteed standard issue, and this often is called an executive carve-out. And that's when we have 5 or more employees. We take that class, if you will, everyone applies for coverage. So it's really a company paid program, all partners, all owners, all employees earning over $100,000. We've created a class, discounted rates. We streamline the plan design, but we do it without any individual underwriting. So it's guaranteed standard issue, and it's most commonly list billed to an employer. I call this group LTD on steroids. Simple concept. Okay, we're in the home stretch. If you sit here and say, okay, I hear what you're saying, I believe in what you're saying, How do we get started? Here's what to look for. Small companies with big incomes. And I use the term big, it's a relative term. One company in Cambridge, that's a biotech firm, may have 7 employees and 5 of which earn over $300,000 a year. Those are big incomes. You may work with a manufacturing company that, their top 5 employees earn over $100,000 a year. Again, big incomes in the eyes of the employer. We can work with that. Other times you may see a company with a clearly defined class. It usually jumps off the paper. There's 5 partners, there's 4 business owners. That is opportunity, because if one has the problem, they likely all have the problem. And then the last one, again, that feels very obvious is if you do life insurance or you do retirement planning and you're doing any key person benefits, that should be and could be a trigger for you to say, hey, let's take a look at the disability coverage. There might be an opportunity here. Last but not least, forgive me on going fast, but again, here's what you need to know. It really all starts with a census. I work closely with the entire team at First American. We create a plan. We find the opportunities, so you don't have to be an expert. All that I ask is if you have a company that you're working with, you can get the census and we can really dissect it and help give you a roadmap to help your client. And what you'll see on the screen here is the info that we need to really work on a disability solution for an individual or a small business. Spoke too fast, went too quickly. Forgive me for that, but I know time is money. Are there any questions, comments, reactions? I would love to answer your questions.
So Josh, I don't have any questions other than just to commend you. Very succinct, great message, actionable items. And, I just, every time I hear a presentation from you and by you with this data, it makes me think of people that I should be speaking to. So thank you for sharing that. The floor is open. We have about 8 minutes left. I think Sean may have left. I see her still on, so she's available for questions. So if anyone needs anything, happy to help. If not, thank you all for attending, for your time. To our carrier partners, thank you for your time, both in preparation and presentation, and your ongoing support. We truly appreciate it. So we'll leave the floor open, and I'll keep quiet for a few moments. You are all muted. If you want to unmute yourselves, happy to permit any questions. If you have questions, you want to email us,